Can you hear me? All right. TT says she can hear me. All right. Good, 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 good. Okay. If you're having problems with the audio, you might want to close out and come back in, and hopefully that's working. But I did have my mic off. I just noticed that. All right. So today I'm going to be talking about how to grow your money. In order to get financial freedom, having your money grow is very important. And I'm not talking about growing by addition. I'm talking about growing by multiplication. It's an important concept. And I'm a big fan of owning a piece of America. I believe if you live in America, you should own a piece of it. And there's ways that you can do that and own a piece of America. So we are going to talk about investing. That's another key aspect of investing. And if you're just catching this live for the first time, this is day number 5. Prior to today, I've covered other aspects of financial freedom. And day 1, we talked about the importance of credit. Day 2, we talked about leverage and residual income. Day 3, we talked about taxes and how you need to get Uncle Sam out your pocket, because taxes are our single biggest expense. Yesterday, we talked about debt, how to get those creditors out your pocket. And now today, we're going to talk about how to grow your money. So we've been talking about some really important aspects of turning your finances around, getting you on the road to financial freedom, which financial freedom is all about having choices, having options, having time freedom, having money freedom, where you're not stressed about money. Because believe it or not, money is the number one cause for divorce. Money is one of the number one factors for poor health and high stress levels. So it's important that we understand. And so what better time to share this information than Financial Literacy Month? So I hope everybody's been getting some value. Please share these posts. My goal is to educate everyone on the different options and some things that you can do right now to get yourself on the road to financial freedom. And it's not as difficult as people may think. Some people are intimidated. They don't know where to start. And my goal is to help share this information and make it practical, show you how easy it can be. So if you've been getting some value out of this, definitely share, give me some likes, give me some hearts. I love to know that I'm really helping people and making a difference. My goal is always about helping and trying to make a difference. So we are going to talk about investing. And like always, I like to share statistics to understand the state of where we are. And unfortunately, again, I say this every night in the series, we are the wealthiest country in the world. Yet, we have a lot of issues when it comes to finances. We control 25% of the world's wealth. Yet we have some major challenges with our financial system, where the majority of the people are barely getting by. So when we think about some statistics related to retirement or investing, only 1 in 3 Americans, or actually 1 in 3 Americans, have nothing saved for retirement, nothing set aside, which is pretty scary. Women are 27% more likely to have no retirement savings. And, for women, it's harder for us because a woman, for every dollar a man makes, a woman only makes 79 cents. So there is a disparity in the earnings that a woman gets. So it does make sense that women would probably be less able to save for retirement than men. Listen to this one. 76% of baby boomers are the ones who are retiring now, are not confident that they've saved enough money for retirement. So that's pretty scary when you think about they're like right here and they're not confident. So that's a scary statistic. And then the average American is only getting $1,461 in Social Security each month. So think about that. Can you live off of $1,461 a month if that's all you're getting? And believe it or not, a big percentage of Americans, that is the only income they have in retirement, is their Social Security checks. So that's pretty scary. And then 56% of Americans lose sleep when they think about retirement. And there is a direct correlation to finances and stress and ultimately health. And so, my goal is to help show some people how you can reduce some of that stress by, number one, getting educated, which I'm here to do. Number two, get yourself prepared to make some changes. And then number three, actually starting to implement some of those changes. Relieve some of that stress, because there definitely are options, and you don't have to be rich to get rich. All right. All right. TT says, I'm trying not to let that be me. Absolutely. You're young enough where you can make some changes. And I learned some of these strategies in my 40s, and it's not too late. As long as you get the information, it's never too late to start making some changes. It's things that you can do right here, right now. And yesterday I talked a lot about mindset. And the first thing is having the mindset to be willing to listen. And two, making sure you're going to be willing to take the steps and get uncomfortable and make those changes. All right. So the other thing that's pretty scary too is another statistic about millennials. This is our 20-something, early 30s millennials. 66% of millennials have nothing saved for retirement, which means, you're going to be in a position, because now, you start having families and life starts happening, right? You're purchasing homes and vehicles and things like that. And now all of a sudden you look up and you're not where you need to be from a retirement standpoint. So it's just all the statistics are showing that we have a challenge in terms of people getting prepared for retirement. And there's a concern with the number of baby boomers that are retiring, which is there's 80 million baby boomers, that there's a risk of what's going to happen with Social Security. So who knows what Social Security will be like, 10, 20 years from now. And then, the days of pensions are gone, where you work for a company for X number of years and they pay you a monthly amount for the rest of your life. Those days are gone. Pensions are gone. So you're relying on your ability to fund your own retirement. That's what 401ks and things like that are. You have to fund your own retirement. And so if you're not doing that, no one else is doing it for you, where is that going to leave you when it comes time to stop working? Because we all have to stop working at some point. So investing is a great way to do that. Investing is a great way to grow your money while you're working, setting aside some of your money to grow so that when you are done working, you've got some money accumulated that you can live off of and not have to change your standard of living to go down because you no longer have that income coming in from your job. So that's really what it's all about. Not to mention stuff that you can live off of today. Investing isn't only just for, the future and retirement. It's also income that you can generate that you can actually use and leverage today. So we're going to talk about different forms of investing and different ways that you can invest. And it's not as hard as people think it is. All right. So let's talk about what does investing mean? What's the definition of investing? So I like to use Warren Buffett's definition. Warren Buffett, of course, is one of the the household names when it comes to investing. He definitely set the bar in terms of how investments work, and he's a great person to pattern if you're looking to invest the way he does it. And so he says investing is the process of laying out money now to receive more money in the future. So it's all about growing your money. You make an investment once and you allow that money to compound or grow over time. That's the concept of investing, to put your money into one or more types of investments. And we're going to talk about different ones because you can diversify or put your money in different places in the hopes of growing your money over time. So if you think about what we covered in day 2, when we talked about leverage and residual income, and I showed the cash flow quadrant, that bottom right quadrant, which was the best quadrant, was the investor quadrant. That's what we're talking about, where you're in a position where you're investing and your money is growing substantially, or it's growing through a rate of return or a percentage, or it's multiplying. That's what we want our money to do. We want our money to multiply. So investing is the mechanism that can allow you to do that. All right. And when we talk about investing, it's important to understand a concept called assets and liabilities. Assets are things that make you money. Liabilities are things that cost you money. So we're going to focus today on assets, the things that can make you money. Liabilities are the things you're spending. That's money going out your pocket, right? We want to talk about things that's coming into your pocket by way of assets. And the strategy is to take some cash, money that you have, buy you an asset that makes you more cash. Not take cash, buy liability that now it's not going to be worth anything, right? So clothes, vehicles, those things are liabilities because you purchase them and they lose value and they no longer are worth anything after a period of time, where an asset increases in value over time. So we want to try to tilt the scale and not have as many liabilities. If your scale is here, liabilities here, and assets down here, then you're upside down. We want to tilt that scale so that your assets are here and your liabilities are there. And it's definitely possible to do. So we're going to talk about that. All right. So let's get into it. Let's talk about some of the different forms of investing. And we basically have, and I'm going to switch over here to my board. We basically have 4 different types of assets, 4 classes of assets that you can use to invest. So the first one is called cash equivalents. And cash equivalents is money, it's assets that are easily attainable or easily liquid, meaning that they're usually a short-term commitment, something that's easily liquid that you can turn into cash if you need to. And they're also usually very low risk. So you don't get a good return or a higher return. So remember, the goal is to grow your money through multiplication, not addition. So when we look at these types of cash equivalents, we have your savings, which is like your bank, right? Your bank. Now think about the bank. And this is something where, as I learned these financial strategies, I had to dispel some of the things that I was taught growing up. We were taught to put all your money in the bank. But here's the reality. A savings account, you basically are getting 0% interest, or meaning your money is not going to grow. You put all your money in the bank, it's just going to sit there. And guess what happens? As inflation increases, the cost of living goes up, the value of that money just sitting there is not increasing. So essentially you're losing money over time by just having your money stockpiled in a bank. So a bank is really good for just things like your living expenses, but you don't want to put all your money stockpiled in a bank. I had someone tell me once, and they were kind of bragging about it a little bit, saying, I got $70,000 in the bank. And I was completely unimpressed because that just showed me you really don't understand how money works, because if you did, you would not have all your savings sitting in the bank, not growing any interest whatsoever. And you've had this money for years, so you've actually lost money by having your money just sit in the bank. So it's temporary. You do want to have some money in the bank for accessing things. CDs or certificates of deposit. Those are things where it does grow. You can get some interest, but it's usually pretty low. Less than, maybe 2% or something like that. A money market fund, very similar, where but CDs, you generally have to have a big down payment, a big lump sum of money. Money markets, you don't have to have as much, and those do grow over a period of time. But with CDs and money markets, you usually have to leave your money sit for a period of time. Otherwise, there's a penalty for pulling your money out. Savings bonds, treasury bills, those are other types of things where you have to usually let it sit for a period of time before you can redeem them to get the value, the actual value of what you're putting in. So you pay a certain amount, and then after a period of time, you get it back with a little bit more. The rate of return isn't that great, but it's less risk. So it's great for maybe older people who don't want a lot of risk. Or like I said, if you just want to do something temporarily where you just need to park your money somewhere. Emergency fund, these are good for emergency funds. If you want to set your emergency fund, because an emergency fund, you need to be able to access it right away, right? But I will tell you this, for savings, here's a pro tip. Think about this. There are some banks where you can earn like a 2% interest, which is better than zero. But a lot of them are the online banks like Ally, like Barclays, where you can go online, put your money online, and transfer it from your bank into this online account, and your money grows at like a 2.2. I think lately it's about 2.2% interest. That's a great place to put your emergency funds, because you can easily make a transfer back to your main bank to get that money. So I tell people that I work with, don't just have your emergency fund sitting somewhere where it's not growing interest, because you can at least get 2% rate of return through something like an online bank or even a money market account. So it does have some benefit, and these are assets, because it's actually cash that you're putting in to the investment. So it's still considered an asset. All right. I see some comments here. Let's see. The things that this company has taught me about cash flow in these 2 years is outstanding. Absolutely, Dexter. So Dexter is my business partner. Dexter understands how the strategies that you learn when you understand money, you don't become afraid of it. And you take control of your money, and you don't let your money control you. And that's part of what I'm sharing here, is to make sure you learn to get more comfortable with how to handle money, and learn some different ways to not be intimidated by your money, but take control of it, and at the same time let it start to grow for you. The next one is bonds. So we have bonds. Bonds are basically loans. A bond, when you purchase a bond, you're basically loaning money to an organization, whether it's a corporate company, a municipality, a mortgage company, the U.S. government. Those are different places where they say, you know what, I need to raise X number of millions of dollars to do a particular project or activity. So I'm going to issue some bonds. And basically when they issue a bond, it's saying, I'm going to give you a note that you give me some money, I'm going to give you a note, and after a certain period of time, I've got to pay you back. Or I might pay you some of it on an annual basis, perhaps. And so that's what bonds are. It's basically a loan that you're giving to an organization, and they're going to give you back some amount of percentage over a period of time. Again, the rate of return on that is not very high. So you may give them, $50, and you may get, a 3% rate of return. Bonds generally, in a lot of cases, have a higher rate of return than the cash equivalents. So this kind of goes from, lower risk, low return, higher risk, higher return. But bonds are still pretty much considered lower risk. And those are good, again, for people who want stability, who are conservative, and maybe you're older. You don't have a lot of time to risk losing your money like in the stock market or something like that. So you get you some bonds. I actually had my emergency fund in a municipal bond fund because I was getting like a 4% rate of return. However, in 2018, the bonds started to turn around a little bit, and they started to lose value. So I actually switched over from a municipal bond to an online savings account, getting 2.2% interest. So bonds are definitely a good opportunity to kind of be secure. Again, you don't want to put all your money in bonds, but it's less risk. Now, should the economy start to do some crazy things and turn around, and if you've got a lot of money on this side, in the stock, you could potentially pull out and park your money in bonds where it's a less interest, or a money market or something like that. Some people use that strategy. But it's a safe investment in terms of you not losing money. So when I talk about risk, I'm talking about the risk of you investing and getting less back than what you invested. Here, you're pretty much guaranteed to at least get what you invested. For the most part here with bonds as well. When you get over here, you run the risk of potentially losing money. So that's what we talk about when we say risk. All right. I'm switching over now to the other side. This is where we get into the more higher risk side of things, but you get higher returns. So, I mean, in investing, that's kind of the guideline. The lower the risk, the lower the return. The higher the risk, the higher return. And when I talk about return, I'm talking about percentages. And while I'm talking about that, I want to talk about this concept that I think you should understand is related to your money when you're investing. There's a concept called the Rule of 72. The Rule of 72 is how long it takes for your money to double. So what you do in order to calculate that, you take the rate of return that you're getting and you divide that number into 72, and that tells you how many years it's going to take for your money to double. So let's talk about a bank. Let's say you got $5,000 sitting in the bank and you have it sitting in your savings account. Well, the bank, you won't even get 1%. Like I was going to say 1%, but let's just use 1% as an example, which in most banks, you're getting 0.0 something. You're not getting, or 0.00, you're not even getting a 1% rate of return just sitting your money in the bank. But let's just say for example purposes, you're putting in 1%, you get 1% rate of return. Well, 72 divided by 1 is 72, right? So it means it's going to take 72 years for your money to double sitting in the bank. So that 5,000, if you put the money in the bank when you're, let's say 20, by the time you're 92, you'll have $10,000. So that kind of illustrates, how it works in terms of investing. Now, let's take that same 5,000 and let's say, you're getting a 9%, 8% rate of return. It's going to take 9 years for your money to double. So you think about that. In 9 years, you'll have another 5,010. So your money is going to double how many times before 72? 8 times by the time it doubles once for that 1%. So you understand the power of investing. So it makes a huge difference, the rate of return that you get. So you want to understand that when you're, looking at investing your money, what is my rate of return? Because that's going to show you how quickly your money is going to compound or grow. All right. So the stocks are essentially ownership into a company that has decided to go from being privately owned to being publicly owned. So when a company decides they want to expand and they need to raise money, they decide, I want to go public and offer shares of my company to investors so they can buy a piece of my company so that I can then take that money that I gain and do whatever I need to do, whether it's in most cases is to grow the company. They're ready to grow and they want to get investors to buy. This is part of when I say own a piece of America is what I'm talking about when you own, because when you buy stock, you're buying ownership into a company. So, and I'm not going to go through all of these stocks because that's like a whole day's worth of session. We just had, I just attended a big conference a couple weeks ago where we spent an entire day going through a lot of this stuff. And even then we didn't really get deep. We kind of just covered some of the basic aspects. So I don't have time on this live. I don't want to keep you guys for 3 or 4 hours. So I'm just going to touch briefly on it just to give you a better feel for what they are. So pre-IPO. IPO is initial public offering. When a company decides they want to go public for a pre-IPO, they'll reach out to some private investors. And generally to be a private investor, you got to have some major coin. I'm talking Warren Buffett type money, right? To get invited to a pre-IPO. And generally that's pretty cheap. The stock is pretty cheap at that point where you get a chance to buy in. You may have heard the stories on Facebook where there were some investors who had an opportunity to purchase Facebook. And, again, it's kind of a risky thing, right? Because you don't know, this is a company that's going public. They're generally fairly new. It's a risk, right? So some people opted not to get shares of it, and they're kicking themselves now because they were able to get it fairly cheap before it was opened up to the public to purchase. So that's what a pre-IPO is. IPO is the initial public offering. The first time that a company goes public, it's now open to the public after the private investors have had their opportunity. This is the first time that the company is going public, and you can buy certain shares or a percentage of that company at that time. The secondary market is after it's gone public and now it's out there and it's being traded. So this is in the secondary market includes stocks and bonds and other types of exchange traded funds or ETFs. So you've got common stock, preferred stock, blue chip stock, growth stock, income, value, cyclical, defensive. So there's all different types of stock. And like I said, I can't go into all of that detail now, but essentially it's based on how some of it is how it's paid out and what kind of sector it's in as well, or the size of the company. There's different characteristics of the stock that puts it into these different categories. And so in most cases, especially in things like 401ks, your money is in a mutual fund, which is kind of a compilation where a bunch of people get together and they pool the money together and they make purchases on behalf of the people who are contributing the money. And it's usually a variety of these different types of stocks. So it's kind of diversified. So that is stocks. And of course, stocks are risky because it depends on what's going on around the world. Different events can have an impact. So you have less control, which is why it's greater risk, because you personally can't go out and impact the stock. It's, what's going on in the economy, current events, things that happen. If a company all of a sudden does something poorly, they can get in trouble. However, the beauty is stocks are very easy to purchase. And some people feel like it's this thing that's just out there, and it's actually not. There are easy ways that you can purchase stocks. One of the new things that has happened now is this concept called micro investing. And I would say the last 10, 15 years, they've made investing where you used to have this advisor. Now you don't necessarily have to have an advisor to get into the stock game. It started with like these companies like E-Trade, where we call them robo advisors, where it's just online, where you've got this online help and support where you can go online and start to do trades yourself. Well, now it's come even further where you can actually get apps that you can download and start trading from. And I think that is genius because it gives people just at the click of your phone an opportunity to start owning a piece of America for as little as $5. And that's why I say it's not difficult to do. And I'm going to talk about some of those apps and show you how you can easily start to own a piece of America and invest in. I'm going to give you an example of my own personal experience with some of those easy ways to start investing and how it's worked for me. So let's talk about it. So micro investing. So let's talk about the robo advising. So there is certain companies that you can go to that are brokers, where you can actually open up an investment account for as little as $25. At the conference I attended a few weeks ago, we actually went on Vanguard's site. If someone could type in Vanguard, definitely worth checking out. And you were able to actually go in and start purchasing some exchange traded funds for $25. So you can actually go in and set up your own account, and there's online help and support. But that's an example of a robo advisor and if you wanted to get on the phone with someone, you could, but you don't have to pay these outstanding brokerage fees to have somebody go in and trade, and you can actually do it yourself. Again, I can't go into the details of things you need to look for. That's like a whole part of the program that I'm a part of, but it's just that easy. Then you can go to like Acorns. Acorns is a micro investing app that you can actually download on your phone, ACORNS, and actually start investing for as little as $5. And the beauty about Acorns, which I love because I actually use it, it takes your spare change from your debit or credit card and it invests it. So if you spend $1.50 somewhere, it takes the 50 cents and it adds it to your investment account. How cool is that? Where you don't even see it. So it's taking your spare change and it's investing your spare change. It's called Roundup. It rounds it up to the nearest dollar and it takes that change and it starts to invest, and it links it based on the purchases that you make on your debit or credit card. So that way you're starting to save money and invest money without even having to do anything. Stash is another one. STASH. If someone could type stash and acorns in the comments. Stash allows you to take money directly from your account. It doesn't do the roundup thing, but it's just a transfer. You can transfer. You can set up recurring transfers. You can set up $5 a week, $25 a month, and invest. And you get to, and the cool part about both of those apps is they actually ask you a series of questions to understand where you are and what your goals are. And then it makes recommendations to you based on what it is that you want. So you could do that and allow them to choose it for you, or you can say, I want Panera Bread, or I want Starbucks, or something like that. So it gives you a lot of power and using these exchange traded funds to be able to start owning a piece of America. I set up Acorns. It's been 2 years, no, probably almost 3 years, maybe 2.5 years ago. I set up Acorns and I just round up my change, allow it to take my rounded up change. And I now have almost $2,000 in my Acorns account. And I'm not saying that to brag. I'm showing you how easy it can be just without thinking. And I went into it because as I was getting ready for this live, I opened it up to see what was my percent rate of return so far. I'm getting like a 5.7% rate of return on my Acorns investment by simply just allowing it to round up the money that I'm spending from my debit or my credit card. That's the power, and that's why I wanted to do this live, to show you how easy it is to be able to do that. And the cool part also is if you refer people, because now it's got, and here's the other part that I love, because now if you've never heard of affiliate marketing is what companies use to grow their business. They say, I'll pay you if you go out and get other people to buy my product. And it's huge, and it's another great way to make money. And this is something that we talked about the other day when we talked about ways to make money. You can actually refer other people to Acorns, and they will get a deal. They'll get money saved, and you will get money saved. So not only do you get to grow your money, but if you share this opportunity with other people, you get to make money off of it. And it's like a double win-win. So, of course, I'm going to put a shameless plug in here, but if you want to get started with Acorns, I can certainly help you out. But it's a great way to get started, guys. Those are just two of them. There's other ones. There's Robinhood. There's Betterment. So there's different ones. Just go out, look them up, and find one that works for you. The key is just to get started, guys. And you'll look up down the road, and you'll have some money set aside, whether that's just your money for trips or your money for whatever it is that you want to use, but it's growing. The money is growing, so it's a beautiful thing. I'm going to stop for a second and see if I have any comments. D'Angela says, thank you. Betterment. So Betterment is BETTERMENT. That's the name of that app. So, you guys definitely check it out. It's a quick and simple, easy way to get started investing and making your money grow. And I just love how technology has advanced to the point where it's allowing people to be able to do these things, which previously seemed so intimidating, which is now so easy to do. All right, any questions? Let's just look at some of the comments. Does it invest in things and places you make your purchases? Well, it doesn't do that by default. You can actually go in and select different companies that you may want to invest in, but it doesn't automatically say, oh, you spent $100 at Amazon, I'm going to go invest in a piece of Amazon for you. So no, it doesn't do that, but you have the choice to select where you want to invest. Good question. Can you show me the roundup at the meeting? Absolutely, I can show you that, Horatia, for sure. For sure. And these are the little tips that I love to share with people I work with. Guys, I'm just a sharer. When I get information, I share it. And that's why I'm doing this in honor of Financial Literacy Month. But there's so many simple things that you can do that you just don't understand. And so, the key is, like you are tuning in, kudos to you for listening because you had an interest of doing this. Some people probably saw this live and scrolled right on by, and probably could have picked up some tips and tricks that could help them, where they maybe spending time watching some videos of entertainment where, not taking the steps to really get the education that could actually make an impact in their lives. All right, so I'm going to move on to the next one. So the last category is real assets. Real assets. So real assets are physical things that you own that, again, can grow and appreciate, which appreciate means grow, to make you some money. So examples of real assets are real estate. Again, that's another way to own piece of America. You own real estate, you own land. You own a piece of America, because America is built on a foundation. So real estate is definitely a big part of owning a piece of America. Private business. You own your business. You get to have the control over how it's going to grow. And that's an asset that you can hand down. And it's an asset that's worth a certain amount of money. So your business is generally worth 10 times whatever it is that you make. So let's say you have a business that's making $10,000 a year. You could sell that business for $100,000, 10 times what you are actually bringing in terms of revenue. So businesses are definitely an asset. I have a business. A lot of people don't realize network marketing is a business. It actually is a business, and you can sell your business and for 10 times what you make and make money off of it. You can leave your network marketing business to your family. So businesses are another great way of having assets that eventually can make you money, and there's no ceiling, and you have better control. Unlike here, you don't have control of what's going on here. Business, you have control. Real estate, you don't have control over what can happen in the real estate market, right? We saw what happened at the housing bubble back in 2007, 2008, where people were losing money hand over fist. I personally was hurt by that. And if you owned a home, you are hurt by that, because your property value all of a sudden tanked, right? People were walking away from their homes. But a business, say the economy goes through a downturn, you can always rebound and go get another business. You can always reinvent and do something else. There's so many ways to make money. I was just watching a documentary just this morning where the gentleman was saying just that. A business there's no better asset than a business, because the power is within you, and you can always rebound and go back and make money. Think about President 4 or 5. How many times has he filed bankruptcy? How many businesses has he had that didn't do well? He filed bankruptcy, got tax credits, and went and started another one. So businesses are definitely a great way to grow your money in terms of assets. Collectibles, different things, collecting baseball cards and things like that. Some of those things appreciate. Of course, when you get into that space, you've got to have a certain knowledge and a certain awareness of what those things are and what's valuable and what's not. I always think about, when I think about collectibles, I think about those shows that come on TV where people are going through these garages or these storage units, or storage wars, I think it's called, where they're looking for these collectibles. Well, those people have an eye, and they know people, the regular person may not know, but they know that there's some value in them, and they look at what they made out of it, and sometimes they can get a huge rate of return when you think about that, based on some of the finds they made. Art is a big one. Art requires a certain skill set to know what's good and what's not, where the trends are, but art can have a very huge upside. I remember the rapper Jay-Z was talking about how, he was so mad at himself because he didn't realize, how owning a piece of art could make him so much money. He came to that awareness, once he was exposed to the fact that you can make a lot of money on art. He got into the art game, right? So another way, futures and commodities, things like currency, gold, oil. Again, those are other things that you can invest in, but again, you don't control those. So those are a little riskier. So these are all the different ways, guys, that you can make money. The key is to get in here somewhere, either saving some money through CDs or savings accounts or money market accounts, or getting you some bonds, or getting into the stock market, the key that I want to make sure everybody understands is there is a way to do it. And if you think about what we talked about in the other days 1 through 4, I showed you some easy ways to free up some cash. You know, if you have a job, you can free up cash right from your job through your taxes. And there's ways that you can do that. And so and I'm going to talk about tomorrow how all of this comes together and how you can take the money that you already have and get yourself on a road to investing, eliminating debt, fixing your credit, all of those things. And so the key here is it's easy to start. You can do it with as little as $5 to start investing. The key is just to do it. To just do it, guys. So I want to see if there are any questions. And if you're getting some value out of this, guys, if you're learning a couple nuggets, give me a 5 or a high 5. Give me a high 5. Type a 5 in the comments if you're getting some value out of this. I want to make sure that what I'm presenting is definitely helping you out. So that's really it for the content. Again, as I have done for every session, the key is not to just share this knowledge, but for you to think about an action step. Because again, it's education, preparation, and action. That's how I coach when I'm working with someone to say, number 1, we're going to get educated. Number 2, we're going to get ourselves prepared to make whatever changes we need to make. And number 3, we're going to move into action and start implementing the changes. And so the action step for today is micro investing. If you are not investing and you have $5 in the bank, get started today. Like literally, like today, you can get started and start to invest, because that's all it takes is $5 to get started. Okay, so that's one action step. And if you want to even just play with it, maybe you are investing in your 401k, because your 401k is an investment. Your 401k falls over here. And I didn't say that, but your 401k falls in this space. It could go here in some bonds, but in most cases, it's in the stock space. In some cases, it could be bonds as well. So start to invest if you aren't, guys. $5. Just don't go to McDonald's or don't get that coffee or whatever it is that you're going to get. Don't get it and take that $5 and start investing. It's really easy to do. Inside of, a half an hour, you can start having your first investment. So it's really simple. The second thing I would say is relative to 401ks or your retirement account. If you work for a company and they have a match, meet the match at least. If a company is willing, a lot of companies say, well, I'm going to match you 100% for the first 4%. Make that sacrifice and invest that 4% so you can get that match, because that's free money that essentially the company is giving you to allow your money to grow. So if you're not at least getting a company match, start to do that with your 401k or your 403b if you're in a government role or a teaching role. The other thing that you can do as another action step is to invest as little as $25 in a mutual fund. You can go on somewhere like Vanguard and sign up, get accounts set up, and start an investment account for $25. You can go through some of the help to get an idea of what you want to invest, or you can get on the phone. I remember the first time I set up my municipal bond fund for my emergency fund, I got on the phone and they walked me right through everything that I needed. I set it up right online. They answered the questions and they were very helpful. So there's definitely some resources available to you to get started. $25, $5, match out your 401k, get started today, owning a piece of America. All right. So, yes, and Horatia says sacrifices must be made. Sacrifices have to be made. I made a post just today on social media about, how our problems are costing us, not addressing our problems are costing us our health, it's costing us money, and it's costing us our peace of mind. So we just have to make an asserted effort to get started. And that's why I'm doing this, because I want to show you how easy it is. It doesn't have to be intimidating. And, you can lay out a roadmap to get yourself out of debt, to fix your credit, to start investing, to get a business, to start getting into business, because as we talked about the other day, it just puts you in a whole different ball game when you're a business owner, and it doesn't cost much to get started in business. So you're right, you got to make some kind of sacrifice, and you got to be focused and have that focus, because this is not, none of this stuff I'm sharing with you is not any kind of get rich quick. I'll be transparent, but you will start to see differences in your life immediately. And when you look up a year down the road, 2 years down the road, 3 years down the road, wow, you're going to be just amazed at the progress that you've made if you've stuck to it and been committed to changing your finances. All right. All right, so I'm going to wrap it up with that. Tomorrow, I'm going to be bringing all of these strategies together that we've talked about over the last 5 days. So I'm going to talk about the roadmap that you can use to bring it all together. Saving money by improving your credit. Growing your money through leveraged and residual income. Saving money by getting Uncle Sam out of your pockets, right? Lowering your taxes. Saving money by getting the creditors out your pocket, by paying off your debt quickly through a debt acceleration. And then lastly, growing your money by investing and getting a return on your investment. Growing your money by multiplication, not addition. All right. And then there's one last thing I want you to type in. If you're thinking about investing, go to bankrate.com. Bankrate.com. If someone can type that in the comments, bankrate.com. That's a great way to go and see what's going on relative to all of these different areas for savings, CDs, money markets. And you can see, and it lists some of the banks that have the highest interest rate, CDs, what's going on. So it's a good way to go and look and see what the current trends are and the companies that's offering the most. That's actually how I ended up going with Ally Bank for my savings, because I looked and they saw that they had a pretty good deal and they had some incentives in there as well. So check out bankrate.com. That's a good resource for you. All right, everyone. I hope you got some value out of this. Please share with other people. Share with your loved ones. Tell them to watch the replay if they missed the live, because the beauty of Facebook Live is it's always there to watch again. Or if you want to go back through it, maybe you missed something I said, you can watch the replay. And I hope that you got some value out of this. And I'll be coming back at you tomorrow, same time, 7 p.m. Eastern, to wrap it all up and bring it all together. Enjoy the rest of your Friday.